Hi friends, very recently this meme was trending on the social media, which is after buying the HDFC Bank dip for the 100th time, the stock is now rallying and we are all getting tired. In this video, I will help you understand 3 hypercritical points about HDFC stock. Point number 1 is why do I remain bullish on this stock on a longer term basis? Point number 2 is what is actually holding down the HDFC Bank, why it is not allowing to rally it. I will talk about some of the factors with some data. And point number 3 is I will speak about and give you some additional triggers that can very well take this stock beyond 2000 levels. I don't know when, but I need to give you those triggers so that you understand the future prospects of HDFC Bank stock. This video is going to be full of learning if you watch this without skipping. With that, let's get this video started. So the first critical point is why do I remain bullish on HDFC Bank on a longer term basis? My entire thesis is that post merger, when we combine HDFC Bank and HDFC Limited, they are going to perform better than the HDFC Bank alone pre-merger, right? Now we need to see whether this is playing out already or not, because it's been already 9 months after the merger has happened, right? So 2 key parameters that I'm going to evaluate. Number 1 is the profit after tax. If you see my screen, you will see that pre-merger HDFC was growing at a 21% CAGR up until fiscal year 2023 from a profit after tax perspective. And now post-merger, if you look at the data, the merger of HDFC Bank and HDFC Limited happened 1st July 2023. So 9 months of fiscal year 2024, the entities have been merged. And if you look at the profitability in 2024, the results were recently announced just 2 or 3 days ago. You will see that the PAT has gone up by close to 38%. What does this mean? This simply means that the profit after tax has gone up by 38%, which is higher rate than the pre-merger situation. So I like this point. But serious investors will now pose 2 questions to me here. Number 1 is that, Rahul, you see the non-interest income here, it has gone up by 57%, and that is taking the profitability very high. This is a very, very fair point because HDFC recently sold their stake in one of their subsidiary, and that income has been realized into this P&L account. That is why profits are looking high. So that's a very, very good counter argument. But I have another point that I want to tell people is the provisions. Have a look at the provisions here and you will see that in 2023, roughly 119 billion rupees of provisions were made, but in 2024, they have almost double the provisions. It's a very, very high provisions. People who are newbies, provisions is the money that the bank keep aside to take care of the bad loans in a very, very simple term. And here what the bank has done is it has increased its provisions by close to 100%. And when I was reading the commentary given by their CFO, what he says is that we have got additional income of 7,340 crores gain from selling the subsidiary, which is what has been seen in P&L. But what we have done is we have used this opportunity to make higher provisions this time in 2024, which is around 10,000 crore rupees. And in my view, this is a very, very good move. This is a very, very welcome move because the bank is preparing itself for a longer term view here. And this additional income, they would have shown very high profits, but what they're trying to do is they are making even higher provisions so that the profits are not looking boosted here. And at the same time, they are taking care of the future eventualities, future contingencies that the bank might face. So overall, if you look at the P&L account, the 38% profit growth is an excellent growth for fiscal year 24. What will it look like in 25? I don't know, you don't know, but on profitability, I'm convinced that HDFC Bank is doing pretty well. Second critical point is the book value. If you look at my screen, you will see that pre-merger, the company's book value was growing at around 16% year on year. But post-merger, again, it has only grown by 16% if you exclude the provisions. But if you include the provisions, then you will compare the book value, which is 502 versus not 580, you will compare 590 and it comes out to be close to 17.52%. So slightly better growth in the book value is what I can see right now. But more importantly, the stock prices are down and the book value is still growing at around 17.5%. Is a very, very good valuation metrics that I am using here from a long-term perspective. And that is why I remain bullish on HDFC Bank from a longer term perspective. Now you will say that, Rahul, you are totally biased. You're only talking good things about HDFC Bank because you hold it yourself. Now let me give you the balanced view, which is the point number 2 of this video, which is why the stock is not going. What is holding this stock back is what I want to speak about. Again, I'll present you a lot of data. Please pay attention. You are going to learn a lot, right? Have a look at my screen and you will see the advances of HDFC Bank, which is the loans that the company gives out, has been growing pre-merger at a CAGR of 21% if you look at the last 10 years data. You can see it here, right? If I now talk about the post-merger situation, have a look at the right side here, which is the gross advances, and you will see that the growth rate has been 55.4%. And this number looks very, very lucrative, but don't compare that because post-merger, both the entities have been merged and that is why you see the 16,000 billion rupees have gone up to 25,000 billion rupees. So this growth is abnormal, mainly because the two entities have been merged. So we can't use that as a like for like comparison. But you see the bank has also published X merger, which is excluding the merger. The growth rate has been 17.3%, which is not a great growth rate if you ask me, because come next year or come next few quarters, the number that we will be comparing against is 23,000 billion rupees, and hardly it is moving from advances perspective. And this is where investors' concerns lie in the short term, because the company or the bank is not growing its loans at a speed that we all would like to do. And this is one of the reasons operationally the bank stock is not doing very well right now. Second parameter is deposits. So again, the same story here. If you look at the data, deposits in the last 10 years pre-merger were growing at 20% CAGR. If you look at the merger data, it is 26.4% here, but excluding merger, the growth has been 18.4%, which is lower than the 20%. The only encouraging sign you will see here is that in the last quarter, from quarter 3 to quarter 4, the growth rate has been 7.5%, which is definitely better. But Q4 always for banks has a seasonality in it. Maybe that is playing out here. Also, one encouraging fact you will see in deposits is that the retail contribution to the deposits has grown slightly from 83% to 84%, which is a good sign overall that their retail is driving their deposits, because retail deposits generally are cheaper than the corporate deposits. If you're liking this analysis so far, hit the like button. Let me know in the comments a simple thank you. Also, you can consider subscribing to my YouTube member community. I post such in-depth analysis on my YouTube member community, and you are going to learn a lot. Now comes the NIMS, most talked point about HDFC Bank. An investor community is booing HDFC for NIMS, right? Have a look at my screen and you will see pre-merger, the NIMS used to be at around 4.1%, which is the core NIMS. Post-merger, it has dropped to 3.4%. It remains under pressure. But one point we need to understand is when you are merging HDFC Limited and HDFC Bank, this is likely to happen because HDFC Limited was an NBFC. It was relying on deposits coming from corporates, not from retail customers. And when that happens, your cost of credit is very high. So in my view, in the short term, the NIMS will remain under pressure. It may not be able to go up to 4% in the next 2 years even, right? It might marginally increase from 3.4% to 3.5%, 6%, but in my view, it will remain under pressure. Now, if you look at the NPA comparison, pre-merger and post-merger, you will see that post-merger, the NPAs actually went up from 1.2% to 1.3%. But good news is that in the last quarter, it has come down from 1.3% to 1.2%. Overall, it remains stable. Overall, bad loans is not a problem for HDFC Bank. Rahul, all of this is fine. Tell us whether the HDFC stock is going to pick up, whether it is going to cross 2000 level or not, whether it is going to be by 2024 or not. All these questions are good. I cannot guarantee anything, but there are two critical triggers that we need to understand, which may take the HDFC stock to a rally. Again, I am not saying it will, I am saying it may. So let's understand those two critical factors. Point number one is that by September 2024, HDFC has to list their NBFC arm, which is HDB Financial. Now, this IPO that is going to come out in September 2024 is one of the most awaited IPO in the financial sector. In fact, investors have been waiting for this for the last 3 years. But now the deadline of RBI is coming very close, that RBI in 2023 mandated that all the NBFCs that are called upper layer have to get listed by September 2024. So there is a regulatory requirement here, and HDFC Bank now is gearing up to list HDB Financials by September 2024. Now, along the journey in the next 6 months, what is likely to happen? There are a lot of news that are going to come out for this IPO, and in my view, that may help HDFC Bank stock indirectly to go into different levels. For example, it was in the news very recently that Bank of Tokyo and Mitsubishi is trying to acquire 20% stake in HDB Financials. And these are the positive news because it is going to unlock value for shareholders from a book value perspective. There is going to be money coming to HDFC Bank that can be used to give more loans, and overall the book value should increase. Now again, do not take this as a stock recommendation. All I am trying to do here is that I am giving data driven triggers that may take the stock prices to the higher level. But please do your thorough research before you start investing in the bank. Point number two that I want to speak about is the RBI repo rate cuts. RBI still is holding up at 6.5% as a repo rate for the 7th consecutive time. So hopefully when the US Fed rates come down, RBI is also going to follow the suit, and in the 2024 it is likely to cut the rates. When the rates are cut, what happens is that the borrowing becomes easier and the home loan rates given by the banks, which are all-time high right now, are going to come down. And what that will do is that will make the credit market more lucrative. More and more consumers are likely to take home loans because the home loan rates are going to come down. That might be another trigger where the quarterly results of HDFC Bank, whenever that happens, is likely to show very good advances, and therefore their profitability might also go up. That might again lead to some momentum in the HDFC Bank stock. Again, I do not know when this will happen and whether that is likely to definitely take the stock prices up, but these are some of the triggers that can take HDFC to the next level. I hope you enjoyed this analysis, and if you did, let me know in the comments a simple thank you, and consider subscribing the YouTube member community. You are going to learn a lot. With that, I will see you in my next video. Until then, keep rocking.